It starts quietly, almost unnoticed. One morning, account holders log into their 401k dashboards, expecting routine updates only to see staggering losses. The balances they trusted to secure retirement have been cut in half. Panic sets in. Millions of Americans confront the reality that decades of saving, investing, and planning are suddenly worth far less. The psychological impact is profound. Fear, uncertainty, and anger sweep across households, and the news spreads rapidly through social media, financial news outlets, and word of mouth. The immediate shockwaves are first felt in the stock market. U.S. equities, heavily tied to retirement accounts, experience historic volatility. Mutual funds, ETFs, and index funds tied to 401k balances see massive sell-offs as account holders and fund managers react to redemptions and panic selling. Analysts scramble to reassess risk exposure, downgrade stock valuations, and forecast prolonged recovery timelines. Wall Street, accustomed to cyclical fluctuations, recognizes that the scale of the crisis is unprecedented. Trillions of dollars of paper wealth vanish in hours, creating shockwaves across domestic and global markets. Corporate America feels the pressure next. Many companies rely on the stability of consumer spending, which is underpinned by confidence in retirement savings. With 401k balances halved, households cut back on discretionary spending. High-ticket purchases such as cars, electronics, home renovations, and travel are postponed or canceled. Retailers, manufacturers, and service providers immediately feel the decline in demand. Small and medium-sized businesses, already operating with thin margins, face revenue shortfalls that threaten solvency. Layoffs, hiring freezes, and reduced investment are inevitable. The banking and financial sectors react cautiously. Consumer confidence affects deposit behavior, loan applications, and credit usage. Banks see fewer mortgage applications, auto loans, and personal lines of credit, slowing the flow of capital. Lending standards tighten, not necessarily due to defaults, but due to anticipated risk from widespread economic uncertainty. Credit card delinquencies and loan payment delays rise as households reassess priorities, creating localized strain on financial institutions. The Federal Reserve monitors the situation closely, ready to provide liquidity or emergency measures to stabilize the system. Housing markets experience delayed but significant effects. Home buyers reliant on retirement savings for down payments pull back from the market. Home equity borrowing slows and construction projects are postponed. Real estate values experience volatility, particularly in regions with high concentrations of retirees or middle-class households heavily invested in 401ks. Homeowners see their net worth decline not just from account balances, but from falling home values as consumer confidence drops. Consumer behavior shifts dramatically. Households faced with reduced retirement security prioritize essential spending over luxury or discretionary purchases. Savings rates may temporarily increase as people attempt to rebuild safety nets, further reducing economic activity in the short term. Industries dependent on discretionary spending, from dining and entertainment to travel and consumer electronics, experience revenue declines. Corporate profitability and employment decisions reflect these cascading effects. The labor market feels the pressure. Reduced consumer spending affects demand for goods and services, leading companies to adjust staffing levels. Layoffs, reduced hours, and hiring freezes spread across sectors reliant on consumer confidence. While large corporations may absorb shocks with cash reserves, small businesses are particularly vulnerable. The psychological impact of the 401k collapse adds urgency to hiring caution, slowing overall job market growth. The retirement planning industry faces existential challenges. Financial advisors, wealth managers, and fund administrators see demand for guidance surge, but also face client frustration and mistrust. Investment strategies are scrutinized, and individuals demand explanations, projections, and recovery plans. Payouts for near retirees are delayed or adjusted, forcing some to reconsider planned retirement dates. Pension plans tied to market performance are similarly affected, adding layers of complexity to both public and private retirement systems. Investor behavior exacerbates market volatility. Panic selling dominates as 401k holders attempt to limit further losses. Hedge funds and institutional investors react defensively, rebalancing portfolios, selling equities, and buying safe haven assets like bonds and gold. Market liquidity fluctuates, trading volumes spike, and indices swing violently. Volatility indexes reach unprecedented levels, reflecting collective uncertainty. Even those not directly invested in the stock market experience secondary effects as financial news drives behavior in broader economic sectors. Corporate investment decisions are altered. With consumer confidence low and equity markets volatile, companies delay expansion, reduce R&D budgets, and postpone mergers and acquisitions. Startups reliant on venture capital face more stringent funding conditions as investors reassess risk exposure in an unstable market. Large corporations adjust earnings projections, stock buyback programs are paused, and dividend payouts are reconsidered to preserve liquidity. The global economy reacts. U.S. financial markets are deeply intertwined with international investment flows. Stock market declines and reduced consumer spending influence foreign markets, particularly those with strong economic ties to the United States. International investors with exposure to U.S. equities experience losses, prompting a reevaluation of risk portfolios. Emerging markets may experience capital outflows as investors seek safer assets, creating ripple effects in global trade, currency stability, and commodity pricing. Social and psychological impacts are profound. Millions of Americans, suddenly facing diminished retirement security, experience stress, anxiety, and uncertainty about their futures. Retirement timelines are extended, lifestyle adjustments are forced, and career decisions are reconsidered. Public discourse intensifies around financial literacy, investment risk, and the sustainability of the 401k system. Political debates emerge as policymakers respond to public concern, proposing interventions, market stabilization measures, and regulatory reviews. The bond market experiences shifts as well. With stock market confidence shaken, investors often pivot to fixed income assets. U.S. Treasury securities, corporate bonds, and municipal bonds see increased demand as perceived safe havens. Yields adjust to reflect new risk perceptions, and borrowing costs for companies and governments fluctuate accordingly. This shift influences corporate financing, public infrastructure projects, and interest rates for consumers. Pension systems face secondary strain. Private and public retirement plans linked to market performance experience asset reductions. Pension funds may need to adjust contribution requirements, modify benefits, or reconsider investment strategies to maintain solvency. Public sector employees dependent on pension guarantees may face delayed payments or revised formulas. The cumulative impact adds another layer of financial uncertainty for millions of households. Healthcare, insurance, and other long-term financial obligations are affected. Households with reduced retirement accounts are less likely to pay for elective medical procedures, supplemental insurance plans, and long-term care. Insurers see shifts in policy uptake and claims patterns. Healthcare providers, particularly those reliant on discretionary or elective services, experience revenue fluctuations. Financial pressures are amplified as households adjust priorities in response to diminished net worth. Corporate governance and strategy are reevaluated. Boards of directors responding to shareholder pressure scrutinize executive decisions, risk management, and crisis preparedness. Leadership teams develop plans to mitigate future exposure to market volatility, diversify investment strategies, and enhance communication with stakeholders. The need for transparency and accountability becomes paramount as public scrutiny intensifies following a systemic loss of retirement wealth. The stock market continues to experience volatility over weeks and months. Recovery depends not only on fundamental economic indicators but also on investor psychology. Confidence restoration requires stability in corporate earnings, government intervention, and visible pathways for market rebound. Analysts publish forecasts with unprecedented caveats, acknowledging uncertainty in consumer behavior, corporate performance, and global market interactions. Long-term consequences extend to entrepreneurship and innovation. With personal wealth diminished, potential entrepreneurs may delay or abandon startup ventures. Venture capital investments become more selective, slowing the pace of innovation in technology, biotech, renewable energy, and other growth sectors. Corporations defer high-risk projects and capital-intensive expansions, prioritizing stability over experimentation. The broader economy experiences a slowdown in innovation-driven growth as financial uncertainty permeates decision-making. Education and professional development are impacted. Individuals approaching retirement or mid-career may delay educational pursuits, certifications, or career transitions due to financial insecurity. Student loans, continuing education programs, and professional development investments are reconsidered. Career trajectories adjust to immediate financial realities, potentially affecting workforce skill distribution and long-term productivity. Government response becomes a focal point. Policymakers may implement emergency measures to stabilize markets, including liquidity injections, temporary tax incentives, or stimulus packages to boost consumer confidence. Social safety nets are evaluated with proposals to extend unemployment benefits, support early retirees, or offer targeted assistance to affected households. Coordination with financial institutions, regulatory agencies, and industry stakeholders is essential to restore systemic stability. The global ripple effect persists. Countries with exposure to U.S. financial markets experience valuation declines in equities, bonds, and derivative products. Trade flows may adjust as U.S. consumer demand softens. International investors reevaluate risk, potentially shifting capital to other economies. Emerging markets heavily reliant on U.S. import demand feel secondary economic stress. Currency exchange rates fluctuate in response to investor sentiment and capital flows. Psychological and cultural impacts endure. The collective memory of a 50% 401k drop reshapes risk perception. Household savings behaviors become more conservative, emphasizing emergency funds over discretionary spending or high-risk investments. Generational attitudes toward investing, retirement planning, and wealth accumulation shift. Financial literacy becomes a public priority, influencing education, media coverage, and policy discourse. Corporate America adjusts operations to navigate new economic realities. Companies reassess capital allocation, delay acquisitions, reduce discretionary spending, and optimize workforce management. Profitability models incorporate higher risk margins, and dividend policies are adjusted to maintain liquidity. Strategic planning shifts to balance short-term stability with long-term growth, emphasizing risk mitigation and adaptability. Investor behavior becomes more nuanced. Risk tolerance decreases across demographics, influencing equity market participation. Mutual funds and ETFs incorporate more conservative allocations, balancing growth and stability. Hedge funds adjust strategies to account for heightened volatility. Individual investors diversify holdings and seek alternative investment vehicles to protect retirement assets. The financial ecosystem evolves in response to systemic disruption. The housing, consumer goods, and automotive sectors experience prolonged effects. Reduced discretionary spending and increased financial caution slow sales, affect production schedules, and influence pricing strategies. Retailers, manufacturers, and service providers recalibrate expectations, emphasizing efficiency and cost control. Employment patterns in these sectors reflect decreased demand, with hiring freezes, temporary layoffs, or wage adjustments. Global financial institutions respond to U.S. market instability. Banks, investment funds, and insurers with significant exposure implement risk management protocols. Cross-border capital flows are reassessed. Emerging markets with financial ties to U.S. equities or pension funds experience volatility as investors rebalance portfolios. International trade and investment decisions are influenced by perceived systemic risk emanating from U.S. retirement account instability. Over time, U.S. households attempt to recover lost wealth. Investment strategies are restructured, portfolio diversification increases, and alternative retirement planning mechanisms are considered. The process is slow and often psychologically taxing. Confidence in financial institutions, corporate governance, and market stability gradually rebuilds, but the memory of a 50% loss shapes behavior for decades. The story of a 50% 401k drop serves as a cautionary tale about the fragility of wealth, the interconnectedness of financial systems, and the importance of risk management. It illustrates how individual decisions, collective behavior, corporate strategy, and government policy intertwine to influence economic outcomes. The lessons extend beyond economics to psychology, culture, and governance, emphasizing that systemic shocks reverberate across every layer of society. Ultimately, a sudden halving of Americans' retirement balances transforms individual lives, corporate operations, market dynamics, and global economic relations. Recovery requires coordinated effort, transparent communication, and strategic adaptation. The scenario highlights the delicate balance between market opportunity and risk, and the profound consequences that emerge when confidence, the cornerstone of financial systems, is shaken.